Welcome back to the Deep Dive. Today, we're wrestling with a market story that just makes no sense on the surface. It's all happening right now in the world of crypto, specifically with Solana. If you've been watching the headlines, you've seen these two narratives that seem completely impossible to, well, square up. On one hand, you have massive institutional firms, the so-called smart money, pouring hundreds of millions into new ETFs built around Solana. But then on the other hand, while all this capital is flooding in, the actual price of SOL has been dropping dramatically. So our mission today is to get to the bottom of this paradox. How can one asset be this huge target for institutions and at the same time see its price just collapse?
Exactly. We're going to dive into the source materials to figure out which story is the real one long-term, the capital flow or the price chart. And we have two key plot points to unpack here. First, the surprise withdrawal of a major ETF player. And then we'll look at the hard data, the record inflows happening against this really steep price decline. This is all about separating that short-term retail panic from, a much longer-term institutional strategy.
Okay, let's get into it, starting with that surprise move last week. The general feeling for most of 2025 was that, okay, Bitcoin and Ethereum ETFs are done. Solana is obviously next in line. But then last Friday, we got this huge curveball. The asset management firm CoinShares, a big name in this space, unexpectedly pulled its registration for a Solana ETF at the SEC. And everyone thought they were going to be a front runner, and they just dropped out.
Right. And what's so critical here is understanding why they withdrew, because the news itself caused a lot of concern. But the official SEC filing said the reason was purely procedural. It wasn't about Solana. It was a failure to get the foundational agreements locked down. I mean, in the world of these complex crypto ETFs, the structural challenges are just immense. You need these watertight legal agreements on, who holds the crypto, how it's acquired. For CoinShares, that basic architecture just wasn't legally finalized. So without that foundation, they really had no choice but to pull the application.
So it sounds more like an operational failure, not a market one. It really shows that getting these things to market is not just about getting the SEC's okay. It's about this incredibly tedious, detail-oriented execution.
Exactly.
And the filing made it clear, right? No shares were ever sold, so no clients actually lost money on this. But for CoinShares' ambitions, it was a big strategic setback.
It was.
And what's so fascinating is the contrast. While CoinShares is stepping back, their competitors are just charging ahead. We saw REX-Osprey launch the first U.S. staking Solana ETF back in June, and then Bitwise followed with their own in October. The door is clearly open if you can get the paperwork right.
And that competitor success brings us to the real engine behind all this institutional excitement, which is staking. I think a lot of people have heard of staking, but they might not get why it's such a powerful magnet for, for big money.
Right.
Staking is basically the crypto version of a high-yield stock. The ETF doesn't just hold the SOL. It uses that capital to help validate transactions on the Solana network. And for doing that work, it earns a reward. Think of it like earning rental income on a property you own. It generates this reliable passive income stream.
And that passive income is the real game changer here, isn't it? It's what sets it apart from something like Bitcoin. So what kind of returns are we actually talking about?
We're talking about a pretty significant and consistent yield. Right now, the reward for staking Solana is somewhere between 5 and 7% a year. For an institutional fund managing billions, finding a predictable yield in that range is incredibly hard to come by in traditional markets. That 5 to 7% is exactly why these products are a hit, regardless of the daily price swings.
You can really see that magnet at work when you look at the inflow numbers, especially for Bitwise. Their launch was just massive. The fund pulled in nearly $223 million in assets on its first day. To give you some scale, that's roughly half of what their main competitor, REX-Osprey, had gathered over several months. The market was screaming that the demand for these yield-bearing Solana ETFs was just, through the roof.
And if we zoom out, the demand is just undeniable. In November alone, Solana ETFs pulled in over $369 million in new capital. This wasn't a one-day thing. It was a sustained multi-week accumulation. What's really interesting is that this was happening while the big players, Bitcoin and Ethereum, were seeing historic outflows. Solana was the outlier. It was the one drawing fresh, dedicated capital into the ecosystem when other assets were bleeding.
Okay, so that brings us right to the heart of the paradox. We've got undeniable proof of nearly $400 million in institutional money, smart money, flooding into this asset. Logically, the price of SOL should be climbing, or at the very least, holding steady.
I would think.
But that's where things get weird. The money is pouring in, but the price is melting down. Despite all this buying, the market price has just completely failed to keep up.
Yeah, let's put some numbers on that because the drop has been sharp. SOL's price has fallen hard since its high of over $250 back in September. In November, it hit a 5-month low of around $120. And if you look back a bit further, that 120 price is a 60% drop from its all-time high of about 295, which it hit back in January of this year. So that's the puzzle. How can you have a 60% drop while $500 million is rushing in?
That's the connection we have to make. And to do that, we have to talk about that January all-time high because it explains the collapse that followed. That 295 peak wasn't driven by institutions looking for yield.
Not at all. That record high was tied specifically to the massive hype around the official Trump Memecoin launching on the Solana network. That event just created this extreme retail frenzy. The price surge was driven by speculative, short-term retail money that was chasing momentum.
Hold on. Shouldn't a $223 million injection from Bitwise alone have provided some kind of floor? Is institutional money really that small compared to retail hype?
That's a great question. It's about market velocity versus accumulation velocity. The selling pressure from the Memecoin hype fading was generated by traders selling back into the market really, really fast. The volume from that retail FOMO and panic was likely in the tens of billions of dollars.
Oh, I see.
So the 400 million in ETF inflows, while it's a lot, just isn't enough to immediately absorb that kind of speculative outflow. And plus, the institutional money is slow money. They're buying to lock up SOL for years to get that yield. They're long-term accumulators taking supply off the market, not traders providing a constant bid against daily selling.
So we've got two different types of capital playing two different games. The price chart is reflecting the come down from the fast, speculative retail money leaving. And the inflow chart is reflecting the slow, steady accumulation from institutions who are in it for the long haul.
Precisely. The price is correcting from an artificial high, while the institutional belief in the network's utility and yield is as strong as ever. And the result? Analysts who are calling for SOL to hit $400 have had to dramatically lower their forecasts. Some are now pretty pessimistic it'll even get back to $150 anytime soon.
That really clarifies the split. Price reflects volatility, inflows reflect strategy. So what does this all mean for you, the listener, trying to separate the signal from the noise? Let's distill the 3 key lessons from this whole paradox. Lesson 1 is about seeing the pattern of smart money versus panic flow. This was a textbook example. While the price was dropping 60% and retail investors were, panic selling, the big institutional funds were quietly buying it all up.
Right. And the takeaway here is crucial. If you're a long-term investor, you have to resist getting shaken out by daily price swings driven by fear. This exact divergence price down, strategic capital in Bitcoin is what big players look for. It's an accumulation opportunity for them. They're buying the correction because they're focused on that future yield.
Okay, on to lesson 2. The power of optimization. We're talking staking and compounding. The whole reason these ETFs exist is that 5 to 7% annual return. Institutions have made it crystal clear. Money can't just sit there. It has to be working.
Yeah, this principle applies to everything. Institutions want that reliable yield, even if the asset itself is volatile. So the lesson for you is to look at your own assets. Are they optimized to generate passive income? If your money is just sitting static, you're missing out on the compounding that these sophisticated organizations are laser focused on.
And finally, lesson 3. The absolute importance of legal and structural due diligence. CoinShares Withdrawal wasn't a market call. It was a failure of execution because they couldn't get the legal and structural agreements done.
It highlights a universal rule in finance. Legal safety and asset structure come first. They're more important than quick profits. Before you commit capital to anything, you have to verify the legal basis, the team, the transparency. Don't let the hype around an asset blind you to those hidden procedural risks.
So this deep dive really shows a clash of narratives. On one side, you have the market chaos from short-term hype like meme coins. And on the other, you have the steady, relentless drive of institutional capital that is focused purely on optimization and generating passive income.
And that institutional focus leaves us with one last kind of provocative thought to chew on. Given this sustained demand for that 5 to 7% staking reward and the continued buying we're seeing from these funds, what happens to Solana's circulating supply in the future? If more and more coins get locked up for staking, the actual supply available on the open market is going to shrink. We could be setting the stage for a pretty dramatic supply shock down the road once all this speculative noise finally dies down.
A fascinating thought. Thank you for joining us for this deep dive into the Solana paradox. We hope these lessons help guide your own strategy. We'll catch you next time.